So chapter 49, topic 49 talks about passive activities and at-risk rules. This is important when you're thinking about tax planning because passive activities can only offset other passive activities. So we're going to talk about the definition of passive activities and the at-risk rules. We're going to talk about computations, treatment of disallowed losses, disposition of passive activities, and real estate exception. When we're talking about passive activities, to determine whether it's passive, you're either active or passive. To be active, a taxpayer must materially participate in the activity of generating income. Losses are fully deductible. Examples are salary, general partnerships, self-employment income. If I have a business and I'm a CPA, or I'm a lawyer, I basically have to do that work in order to generate the income. It's not passive, I have to do something. The passive activity rules were enacted by Congress in 1986. It was thought to curtail widespread use of tax shelters in order to create losses for tax reasons. So these rules apply only if activities generate a loss. Any gain, whether it's passive or active, is taxable, right? So a passive taxpayer does not materially participate in the activity of generating the income. So if I'm a limited partner, then I'm basically not, this is not an active activity for me, it's a passive activity. Losses are deductible only to the extent of passive income. And if you don't have passive income, then the losses are suspended and allowed in a year of disposition. Examples are limited partnership in real estate. And there's some exceptions to real estate, which I'll talk about in a few minutes. And then portfolio. So taxpayer invests in traditional investment activities. The losses are fully deductible. Examples are interest and dividends. So there's a difference between active, passive, and portfolio income. So for passive activities, if it is a rental activity and limited partners are always passive. The exception is a real estate professional can avoid the passive rules if they provided more than half of his or her work in real estate and he or she works more than 750 hours per year. All other business activities are passive unless one of the rules applies. The client participates more than 500 hours a year. The client is the only participant in the business. The client participates 100 hours and which is more than any other participant, or the client materially participates 5 out of the last 10 years. Also, if the client provides personal services, like an accountant, a lawyer, any of those things, consulting, those are all personal services, so that's not a passive activity. Passive losses can only offset passive incomes. Any remaining loss is carried forward until used or deducted in the year that the passive activity is sold. How to calculate passive activity losses? How much of her passive activity loss can Brenda deduct this year? If she has a salary of $50,000, a passive loss of $10,000 from a big limited partnership, and passive income from a little limited partnership of $2,000, Brenda can only deduct the $2,000 of her passive losses, so she has $8,000 remaining, which she'll carry forward to future years. When we're talking about disposition of passive activities, after the entire interest of a passive activity is disposed of, suspended losses from previous years are fully deducted against other income. So another example, how much of her passive losses can Brenda deduct this year? She has a $50,000 salary, $10,000 in passive losses from big limited partnership, $2,000 in passive income from limited, $5,000 loss on the sale of the partnership, and $6,000 in suspended losses. She has $16,000 in losses, passive losses. She can deduct all $16,000. $10,000 of the passive activity loss this year, plus the $6,000 in suspended losses. She'll offset the $2,000 passive income from little limited partnership, and then offsets $14,000 of her salary. Brenda can also claim a $5,000 long-term capital loss on the sale of her partnership. So let's talk about rental real estate. The rental real estate is a special rule that up to $25,000 in passive losses from rental activities may be deducted from other income if the client actively participates, arranges for maintenance, screens tenants, etc. The client's modified AGI is less than $100,000, and it's reduced by every dollar for every $2 that modified AGI exceeds $100,000. It's completely phased out after $150,000. So an example, Liz had $40,000 in rental losses due to a kitchen fire. How much of that loss can she deduct if her AGI is 130? She can deduct 10,000. So the 130 minus 100,000, right? Divided by 2. So the 25,000, which is $10,000. She can carry over the 30,000, which she couldn't deduct this year. It's a carry forward. And another thing to talk about that wasn't mentioned in the slides is rules for vacation property. Vacation home rentals have special rules. If a vacation home is rented for less than 15 days in the year, the rental income is not included in gross income and the taxpayer can take no deductions for the rental use of the home. Nevertheless, the taxpayer can take the deductions of the mortgage interest, property taxes, and casualty losses. These deductions do not depend on rental use. If the home is rented for more than 14 days and the taxpayer does not use the property greater of 14 days or 10% of the number of the days that the home was rented, the home will be treated as a rental property. In this case, the taxpayer can deduct all expenses allocable to rental use. The allocation is the ratio of the number of days of rental use to the number of days of total use. Some courts use the number of days in a year. The deductible rental expense includes maintenance, utilities, depreciation, and repair. Note that mortgage interest allocated to personal use days will not be qualified resident interest and is not deductible. If the client stays in the vacation home to make repairs or remodel, the days spent to make repairs and remodel do not count as personal use or rental use. A vacation home is a residence that if the owner's personal use is longer than 14 days or 10% of the rental use. In this case, the deduction for rental is further limited to the gross income. So basically, if you use the home and you rent it for more than 14 days, but you also use it, let's say you rent it for 3 months, but you use it for 6 months, then you can deduct up to whatever gross income you took in. And the passive loss provisions, as previously discussed, applies to vacation rental homes. And that's just an overview of passive activities and the losses generated by them.